The new year has been anything but happy for equity investors, with worries about weak global growth and even weaker oil prices. Investors are now turning away from risky assets as we have seen more volatility in large and small cap stocks and a downward trend in oil prices. Keeping in mind the inverse relationship between bond prices and bond yields, this flight to safety is fueling a rally in Treasury bonds that pushed the yield on the 10-year note below 2% last week. Overseas investors reaching for yield were a key performance driver for Treasuries in 2014. Those investors are now seeking a safe place due to fears about the global economy's direction, and with the relative strength of the U.S. economy, that safe place is U.S. Treasuries. The decline in oil prices is pressuring the U.S. high-yield market, as much of the marginal issuance has been coming from energy companies raising capital for shale oil projects. With crude now below the $50 range, there's an increasing chance that the issuers may default on their debt. The response by many investors is to get out of high yield and into treasuries. Treasuries are also benefiting from the unwinding of a massive global carry trade, in which investors borrowed heavily in dollars and used that money to invest in emerging markets. The stronger dollar has squeezed out all of the profits from these transactions, and with the expectation to raise short-term interest rates by mid-year, the dollar will continue to strengthen, and the proceeds from the unwinding carry trade will keep flowing into treasuries. That is your investment for this week, and we will see you next week.